All right. So Chapter 7, Investments. What I'll do today is kind of give a general overview, and then tomorrow, the next day, what I'll do is supplement this with an illustration of one particular investment. Those investments which are subject to capital gains, capital assets, investment in capital assets is what we're talking about. So today is just kind of a general overview of investments, and then today or tomorrow, tomorrow, the next day, I'll do a more in-depth lecture concerning how we deal with capital gains or capital losses. So, here, when we're talking about investments, we're talking basically about assets that are either considered portfolio investments or passive investments. Portfolio investment income is dealt with in the year, well, at least from the extent it's from like interest, royalties, stuff like that, is going to be at a, well, it's going to be taxed in the year it's earned. But there may be other portfolio income that is taxed at a later time. Anyway, we'll talk about that here. And then if you have portfolio losses, those may be deferred until the investment's sold. And so portfolio income, interest and dividends, portfolio income, are taxed when received. Interest from bonds, CDs, and savings account are taxed at ordinary rates, ordinary income tax rates, unless one of these bonds is or more than one of these bonds is a municipal bond. And if you recall, those are, municipal bonds are not taxed. They're non-taxable. Dividends on stock are taxed at preferential capital gains rates, usually 15%, but it could vary. And so, again, 15% usually. But if that dividend income would have been taxed at a marginal rate of 10 or 15%, had it been ordinary income, then that qualified dividend is taxed at zero. So that's to help out lower income individuals. If you're a high-income individual taxed at a marginal rate of 39.6%, then you're going to be taxed on qualified dividends at a rate of 20%. But most people are going to fall within those middle ranges of ordinary income marginal tax rates. So they're going to be taxed at 15% on qualified dividends. Recall that the after-tax rate of return would be, as we show here, on an 8% before-tax rate of return. You have to figure out the after-tax rate of return by subtracting the whatever the preferential rate is here, 15%. You have to subtract that from 1, so it's going to be 85% of 8%, or in this example, 6.8%. Non-qualified dividends are taxed as ordinary income. So the question here is, why would you invest in assets yielding interest or dividends? Some of the non-tax factors are the risk involved, diversification. I'm not real big on this stuff, but if you want to look at that in the book, that's fine. All right, so capital gains and losses. Capital gains and losses come from investment in capital assets. Those capital assets are usually either portfolio assets or, stocks, bonds, etc., or land and other personal use assets. And so the characteristic involved, common among all those assets, is that they are held for their potential ability to appreciate in value. Could include collectible art, collectible cars, vintage cars, things like that are capital assets that have the ability to appreciate in value. And so whatever type of capital assets it is, the gains on these assets, it may appreciate in value over time, these capital assets, but whatever appreciation occurs is not realized or recognized until some sort of transaction occurs, the sale of the capital asset. And again, taxed at preferential rates when it is sold. So it's a win-win. Well, what happens if you sell a capital asset for a loss in a particular year? What happens with that loss? Well, it depends, and we'll get into this netting process that you're required to do when you have the sale of capital assets. But let's say you do have what they call a net capital loss. If the loss, any of the loss occurs due to investment in personal use assets, those losses are not deductible at all. So the sale of capital gain personal use assets is not deductible. None of it. But if it's other type of capital asset property and it is sold and the sale results in a net capital loss, then what individual taxpayers can do is deduct up to $3,000. You can offset ordinary income by $3,000 of your net capital loss. Well, what happens to the rest of it if there's an excess of net capital loss? Well, you get to carry it forward. So we'll talk about that as well in the future. So anyway, it all despite what as long as it's a capital asset, as long as you're getting some sort of income from the capital asset or appreciation of the capital asset, you're going to have this taxed at more favorable rates, with the one exception being personal use capital assets. If you dispose of it at a loss, you get no deduction there. If you sell a personal use capital asset at a gain, though, you're going to have that gain taxed at favorable rates. So how do we define capital asset? Here it says that it's any asset other than assets used in a trade or business, accounts or notes receivable acquired in business from the sale of services or property. Capital assets do not include any sort of inventory. And that makes sense. I mean, that's the kind of stuff, some of this stuff is characterized like an asset used in a trade or business. These are not capital assets. Depending on what the asset is, it still may be taxed at a favorable rate, but not under the definition of a capital asset. It might be what they call a Section 1231 asset, might be a 1245 asset, or a 1250 asset. Accounts or notes receivable and inventory are considered ordinary income type items in a trade or business, so it makes sense that those would not be taxed at a favorable rate either. And so you might hear the term long-term capital gain or short-term capital gain or long-term capital loss, short-term capital loss. What makes a capital asset a long-term asset or a short-term asset? The answer, for the most part, is, especially in the case of purchased capital assets, if it's held for more than 1 year. If a capital asset is held for 1 year or less, it's a short-term capital asset. Now there's some different rules here if the property is acquired by other than purchase, such as if it's a gift or inheritance, things like that. Looking here to see when we discussed that little matter. I don't know if it's in this chapter. But I'll just mention it that if you acquire a capital asset by gift, you get to include the time that the donor, the person who gave the gift, you get to include their holding period in determining whether it's a long-term or short-term capital asset. Same goes for inheritances. So what determines whether or not a capital asset is sold for a gain or a loss? Well, what you do is compare the proceeds of the sale or exchange. In other words, what the taxpayer is getting. Again, it doesn't have to necessarily be cash. It could be an exchange of assets, one capital asset for another capital asset, for instance. And so, but let's just talk about, for ease, selling for cash, because that's the usual instance. You're going to compare the proceeds you receive with the capital assets adjusted basis or tax basis. And if the proceeds are greater than the tax basis of the asset, well, that's going to be a gain. And then based upon how long the asset's held, you're going to determine whether or not it's a long-term capital gain or a short-term capital gain. So that's kind of how that works, and we'll go through some of that here in the next few days in the supplement lecture on capital assets. This is part of what we'll talk about in that supplemental lecture, but I'll just kind of go through it pretty quick. You determine your capital gains by this netting process, and whatever the netting process determines, it's going to determine some various scenarios. I mean, if you just have the sale of one capital asset, you have to figure out if it's a gain or a loss and determine then if it's short-term or long-term. But if you're selling numerous capital assets, that's when you get into this netting process. And the netting process in general involves comparing your long-term capital gains, your long-term capital gains against long-term capital losses, and depending on the outcome, you're either going to have a net long-term capital gain or a net long-term capital loss. And then you're also, if you have any, going to compare your short-term capital gains against short-term capital losses, and you're either going to have there a net short-term capital gain or a net short-term capital loss. Okay, and so anyway, that's about all I'll say on that. But what could come out of this is if you have a net short-term capital loss and a net long-term capital gain, what you're going to do is compare those two, and if net long-term capital gain is greater than net short-term capital loss, the difference is called a net capital gain. And that net capital gain is what's taxed at this preferential rate of either 0, 15, or 20%. Now I'm going to try to keep this pretty basic. So, you know, they talk about other rates. That's for like collectibles and stuff like that. So we're not going to get into that. We're going to keep it pretty basic. If if through this netting process you have, let's say, possibly net long-term capital losses, and in addition you have net short-term capital losses, either one or both, you're allowed to deduct up to $3,000 of the net capital loss against ordinary income. The remainder carries over indefinitely to subsequent years. So that's a pretty good deal. And so we'll get into this netting process here in the next day or so. So I'm going to skip over this. Remember, when you have capital losses, if it's from the sale of personal use assets, certainly any gain from the sale of personal use capital assets is taxable as a capital gain, but any loss due to the sale of personal use assets are not deductible. All right, so not going to really cover wash sales, not really going to cover related parties. Not really going to be involved with investment expenses either. The other thing I want to talk about, and I went too far, is passive investment income and losses. And so here, what you've got going on, and again, some of this is a cat and mouse game. What happened in the past is that taxpayers would invest in limited partnerships, and these limited partnerships were sold in order to generate losses. And before the law was changed, they could use these losses in these partnerships to offset other ordinary income. And so Congress and the IRS moved to close this loophole. And so what they did is come up with these passive income, passive investment loss and income provisions. And so the current structure limits how you treat passive investment losses, especially. And so if you have income from the passive losses, or excuse me, from the passive investment, that is generally going to be taxable in the year it's earned. Now, the losses created by these passive investments are possibly deductible, but only if they meet certain thresholds. Those tests in those thresholds are called the tax basis limitation, at-risk limitation, and passive loss limitation. You have to jump over each one of these hurdles before you can possibly deduct these losses. Now, the first limitation, the tax basis limitation, and you come at it in this order: the basis limitation first, and then you go to the next one, and then you go to the next one. And so the tax basis limitation just says that losses may not exceed the investor's tax basis in the activity. Excess losses are carried over until some event occurs that creates more tax basis. How do you increase tax basis? Well, you can invest more cash into the passive activity. There could be future undistributed income from the passive activity that would increase the taxpayer's basis in the investment by their proportional share of that income. Or if the passive investment incurs debt that the passive activity holder is obligated to pay, that share of debt increases their basis as well. Now, there are certain things that decrease tax basis. If the passive activity, such as a partnership, a limited partnership, distributes cash to the taxpayer, that's going to decrease their tax basis. And then if you have prior losses that carry over, that could decrease the tax basis. Next is the at-risk limitation. And generally, the taxpayer is going to be at risk up to the amount of their investment in the activity, but there are exceptions to that. The main exception is when the passive activity, such as a limited partnership, incurs debt and the taxpayer is obligated on that debt. And so losses may not exceed an investor's at-risk amount in the activity. Any excess loss is carried forward until the event occurs, some event occurs to create additional at-risk amount. So let's say taxpayer invests $50,000 in a particular passive investment. The passive investment has $100,000 of losses and no loans. Well, they're going to be limited to their basis, number one, and that's also the at-risk amount. Now, what would create additional at-risk amount if the passive activity incurred some debt that the taxpayer was obligated to pay? That would increase their at-risk amount. So the at-risk amount is calculated like tax basis, except that it may not include the investor's share of debt she is not responsible to repay. So they have an example here using these first two hurdles, the tax basis hurdle and the at-risk limitation hurdle. Lon purchased an interest in a limited liability company for $50,000 and the LLC has no debt. Lon's share of the loss for the current year is $70,000. Well, the first test, the tax basis test, would only allow him to deduct $50,000 of the $70,000 loss. He would, since there's no debt, he would also be limited by the at-risk limitation to $70,000 or $50,000 as well. Now, the third limitation is called the passive activity limitation, and this is applied after applying the first two limitations. Usually, those first two are going to knock down any sort of excess, but not totally true, and so that's why they have this passive activity limitation. They want losses. I think what they're trying to do is make sure that not only does the taxpayer have some skin in the game as far as, you know, having enough basis and at risk involved in this activity, but they also want to make sure that there's some substantial participation in the activity by the taxpayer, not just sitting back and letting things happen, let somebody else handle it. And so what they do here is they essentially lump activities into three sections. And of course you have your things like wages and, you know, income from self-employment, that sort of thing. That's going to be lumped into your ordinary income type. I'm looking here to see if they have Normally they have some sort of, Exhibit 7-9. You have your active income or loss category. That's wages, income from self-employment, things like that. You've got your portfolio income or losses. That's investment in capital assets, those sort of things. And then this passive income or losses is segregated from those first two. And the point here is that any losses from passive activities may only be deducted to the extent that the taxpayer has income from passive activities or when the passive activity is sold. And so a passive activity is a trade or business or a rental activity in which the taxpayer does not materially participate. And so participants in rental real estate and limited partnerships are generally considered, well, the limited partners in a limited partnership are generally considered to be passive participants. All other participants are considered to be passive unless their involvement is regular, continuous, and substantial. And so they have 7 factors that they look at, the IRS looks at, to determine whether or not a taxpayer is materially participating in the activity. And if you meet any one of those 7 factors, you are considered to have materially participated in that activity. Well, and there are the 7 tests. And again, you only have to meet one of them. So here's an example. In addition to his interest in the LLC, Lon owns a rental property that produced $5,000 of rental income during the year. How much of his remaining $50,000 loss, the $20,000 from the previous example, can he deduct currently? Well, essentially what he can do is deduct, well, the $5,000 from the excess $20,000. So he can use $5,000 of that. What happens to any portion of the loss he can't deduct? Well, the other 15 just gets carried over till somewhere down the line, hopefully, he gets more passive income. So Lon may use $5,000 of his passive activity loss from the LLC to offset his $5,000 of passive income from his rental real estate. He must carry forward the remaining $45,000 passive activity loss until he further receives more, well, it's not even the $20,000, it's the whole $50,000 that's not deductible because, again, he didn't have, didn't meet all 3 requirements for that. again, you have to consider every investment. And here, what's happened with his LLC is it's like a limited partnership. He was limited by the first two to $50,000, but then he didn't qualify under the passive activity limitation because he didn't materially participate. I mean, they don't really tell you that, but I think that's what you have to assume for this, is that none of the $50,000 loss is deductible here, so he didn't materially participate. So because he didn't meet all three requirements for the LLC loss, none of that $50,000 is deductible except against other passive income or passive income in the future from his interest in the LLC. So anyway, I think you kind of have to know those facts to get the full understanding of this illustration. So anyway, what he's doing is taking the 5 from the rental real estate, passive income from the rental real estate, and offsetting that against the passive activity loss from the LLC. Now there is one exception to this passive activity loss rule that allows lower incomed individuals, those who have AGI of 100,000 or less, to deduct a certain amount each year for rental real estate losses. And so here we have an example of this couple who own a home. They rent out to students at a local university. The husband approves new tenants and makes repairs when needed. Their AGI before considering any income or loss for the rental property is $90,000, and their loss from the rental property for the current year is $16,000. If they have no other sources of passive income, how much of the passive loss from the rental home can they deduct currently? Well, they can deduct all of it, because they can deduct, because they make less than $100,000, they can deduct up to $25,000 of losses each year from rental real estate, even if they don't have passive income from other sources. And so that $25,000 is used against ordinary income or portfolio income. Now, between 101,000 and up to 150,000, there's a phase out for every dollar in excess of $100,000 up to 150. So it's a phase out of 50 cents for each dollar of AGI they earn above 100,000. So it's zero. That makes it zero at 150,000. All right, so what'll happen next, I'll do more in-depth lecture and hopefully more coherent on the netting process of capital assets, the sale of capital assets.